All right. I got 2 o'clock. So we're going to get going on the 2 p.m. session, Raising Capital in the Middle, an Investor's Perspective. So I kind of said it earlier, but there's all kinds of things going on downtown. If we get some sound or something, there's a rock concert going on next door, which is funny to say out loud for some reason. But welcome to the 2 p.m. session. So this session is part of the Martin Pringle pre-revenue track. Martin Pringle has been an awesome supporter of all this. They were there with us at the very, very, very beginning. They helped us sell out our kickoff event at Jenny Dawn, and they've had speakers. They've been present, and their support has just been incredible throughout all this. But now I'd like to introduce you to Dan. Dan Kerr is part of Flyover Capital. Rewan's deal flow and analysis and brings a background in operating early stage companies and financial services. He's a firm believer that the best people to advance the region's industry through technology are right here in flyover country. Current investments include Verizon, Triple Blind, Layer, and Lending Standard. Help me welcome Dan.
You hear it? All right, here we go. So great to be here, and I have to say, Chris, awesome job organizing this, and I know this is an incredible amount of work, but super important to keep the energy going and build up the ecosystem in this way. I think also really humbled to take the stage right after Brian, who brings such great experience to the region. And really so many great points made in the last presentation. Then I think a few things that I can dive into on the investment side of things. I'll tell you a little bit about Flyover Capital here today, just so you have a baseline of where I'm coming from, but then I'll spend the majority of the time talking about really kind of the tactics and a few key points about what we think works in raising venture capital. I will talk about a broader investment landscape, but really my world is the world of venture. And as Brian talked about, today's companies, to be successful, are not just, setting up shop and growing. They need to grow quickly. And oftentimes that does include something like venture capital that's, by nature designed to accelerate things very quickly, and put a lot of resources behind a company with the right characteristics to grow quickly. So really my goal here is to just, educate you, be an open book about what we see, what we think makes success, and what's kind of unique to our region as well, given the capital landscape and the founder landscape, as well as the incumbent businesses that are out here. Talk about, as I said, we'll focus most of the time on preparation and process. There's a lot in here that's probably, a much longer presentation, and I would encourage anyone that's looking to go down the venture route to explore, accelerators and other resources on this topic, because I think ultimately, as you go through this and you learn about the culture that is built around building high growth businesses, it isn't as much an art as a science, and what in the kinds of things you need to do and say to be positioned for venture capital is not something you can just quickly read a book and go out and do it. It's something I think you really have to be around, and you have to spend real time and really educate yourself around that culture. And then we'll save plenty of time for Q&A at the end. So who am I? What is Flyover Capital? Well, we were formed to create successes outside the traditional tech hubs. So our fund is based on focused on the United States. B2B enterprise software is our focus, and we don't invest at all in sort of the most obvious areas of where technology is. We don't invest at all in the Bay Area, New York, or Boston. And you'll see here I have a map in here to show kind of our overall landscape. That is, this is the zone that we really focus on: Twin Cities down to Houston, Denver to Atlanta. We really like, traditional Midwest, Southeast is really our focus. So just to give you a sense of where we play, so we are an early stage venture fund. We tend to come in pre-Series A. Typically, these days there's a big spectrum of early stage capital. We tend to be seed or post-seed in where we invest. We do invest in companies occasionally as early as pre-revenue. That is definitely the exception for us. But they're always have identified, they've built a product, they have validated in the market some way what they're doing, and typically are in the range of several $100,000 in revenue before we're investing. This is our team. Important thing to know about us is all of us have been operators at some point. The founding partners of the fund, Thad and Keith, were both operated early stage tech companies successfully in the Kansas City area. So really started our fund investing in 2015 to address a problem that they saw, which was there's not much in the way of venture capital in the region, and we need that component of the ecosystem to be successful. And they knew that, the way companies are created today, it's very distributed where great companies are being formed. As Brian suggested, even now with remote work, there's so much possibility to grow companies right here, really anywhere. And so here's the rest of our team as well. And I think it's interesting, this picture, because two or three of these folks I've never seen wear a jacket before, other than for this photo. But and this is our focus. We've invested in, I think, 21 or 22 companies over our life. We're very active right now in the market. So that's just a general sense of where we've invested. Another key pillar of what we focus on is not only regionally, but we look for, where can we leverage incumbent industries? Where can we leverage university talent pools? And these are some of the industries that we focus on. These, I view these as sort of the businesses down the street that exist today. And across the board, these folks are investing in technology to run their companies. We like to find those enterprise software businesses that make things like the logistics sector or financial services operate a lot better or grow their revenue. So let's get into the meat of this a little bit. I'll start out with how just a real high level on what is venture capital, to set a baseline. So, what venture capital is, we're making an equity investment in the company. And it's typically where, there isn't enough there for another form of finance to get behind it. Venture capital can come in as early as just an idea, but that is often served by angel investors. But it is focused on a company that tends to be relatively capital light in what it needs to do to get to market, but needs significant capital behind it to grab market share and build quickly to stay ahead of the market. And so another factor would be that this is not going to go public or not going to have a transaction for a while. We're expecting to invest in the early stages to hit some key milestones and some key inflection points for the business to make it a lot more valuable over a relatively short amount of time. Another fact is that most venture backed businesses are not going to be infinitely run by the founding team. At some point, they're likely to have some kind of exit. By the nature of a venture fund, they're limited life vehicle. They're intended to invest in a pool of companies, anywhere from 10 to 20 or 30 companies over the life of their fund, and there is an end date. And so they need at some point to get their money back. Either the business succeeds, maybe the exceptional company becomes an IPO, but most companies exit to another company, or they just at some point offload the assets and close their doors as well. But there is an end date to most of these companies as far as kind of the ownership structure that the venture capital company fund is going to come in and invest on. A little bit just to orient around what venture capital funds are very broadly doing. Well, they're looking at the team and the business, and that's often referred to as the jockey and the horse. And most venture funds will tell you they're going to lean heavily towards the jockey. They believe that the founder of the company and the founding team is super important because there are very few data points for them to invest in, especially in the early stages. I like to think of this kind of by stage. I think that this is a spectrum that at the very early stage, the only thing you have is a jockey. You don't even have a horse. And then as you get later and you put more data points together, there starts to be a real business with real numbers and real metrics that your Series A or your Series B investor is going to focus on, and they're going to start to look more about business fundamentals and who could you sell this business to over time. So folks like us that are at the seed stage, we have a limited set of data points, and then we spend a lot of time on the team because that's basically who we're entrusting to fulfill a big vision. Another factor of venture capital is it tends to be a very active market and a very pretty much open market in that data is shared very quickly among funds. Venture funds look at a whole bunch of deals to whittle down to a very few. And I think that's a very important thing to remember because that can lead to a lot of frustration if you're not prepared when you go out and try to raise venture capital. Because they may initially show interest and pull back very quickly if they don't like what they see. So just a few things about, does venture capital even make sense? I think one really positive outcome of this can be deciding that you're not the right company for venture capital, because it's definitely not for every kind of business. I think I'll hit on the second bullet point there first, actually, and that is momentum. Is this a business that has lots of momentum or can have lots of momentum? Again, software tends to be heavily invested by venture capital because it can have a lot of momentum. You can do a lot of very scalable things very quickly in the software world. And then as you're going along, raising funds over time, you have to keep up the momentum. You have to keep showing data points and keep showing things that make the company show that it's growing and has potential to go a lot further. Another one I'll touch on is just obvious scalability, which I think gets, again, back to sort of software or other highly scalable types of businesses, is that there's just no question that if this thing succeeds, you can put in a certain number of dollars and you can get a lot out the other end. So that's typically why a service-based business maybe isn't the best fit for venture capital, because that scale isn't there. They can grow to be multi-billion-dollar companies, but require a lot more human resources to go into them. I'll just touch on one other point on this slide, is that at the bottom, one of the best things you can do in figuring out whether or not you think you want to raise venture capital or if it's the right fit for you, is to talk to peers, whether they're here in the region, other people that have raised venture capital, or folks that are in your industry, and have a good conversation about what it took and what it meant and why they think they were a good candidate for venture. And so then this is just a little bit about the personal side of things. The one thing I'll touch on here more than anything is resiliency. I think that comes up with any small business. I think also, but when you're raising venture capital, that making sure that comes through is a very important thing. Up there at the top, I mentioned balance. So I think one of the things that we're always looking for, and I think that is the very tough thing to qualify for, is finding a great match between someone that has got a great vision and high execution. So that is, the two key things you're sort of balancing out as you're looking at candidates for great founders. And by the way, these will be shared later, so that's why I'm only touching on a few points. I won't spend much time here because I know there's some other sections on angel investing. I will say many of the companies that we invest in, even at the seed stage, have already raised angel capital or friends and family capital. That's where so many founders start. My main thing, the questions I get most often, like were asked before, is where do you find it? Where do you access angels? And to me, that's, it's about that jockey equation. It's about you and growing a personal relationship, or finding someone that really resonates with the kind of business you're building and knows your industry really well. Other sources, I think great things, like this is sponsored by Techstars, finding a great accelerator that can help you understand this process of building your company and raising capital and what it means to put the right structure around your business, in addition to putting some capital into the company. Another alternative is bootstrapping. Just there at the bottom, there's many great businesses formed just by getting into market and starting to grow revenue however you can. And so that is, that is something that I don't even, that is the huge spectrum of companies that have gone very far, or those that simply have just done it on their own. I will skip this one and get into preparation. And again, I've got a whole lot of content in here, and I'm only going to hit a few points on this, but I think that just the very idea of preparation is essential for going out to raise venture funding, because the last thing you want to do is have a great business, great seeds of a business, and be out there and not really know who you're wanting to sell this to or how it's going to resonate to the market. So talking to folks early on, getting to know them, get to know what they're looking for. Each venture fund is a little bit different in their criteria, their stage, the kinds of metrics they look for, and certainly the industry. And so and you're not going to get very far trying to convince them that something outside of their zone is worth spending much time on. They might be willing to make introductions for you, but starting those relationships very early on is important. Being sure you're qualifying them, not just that they're qualifying you. Be sure to ask them lots of questions around their focus areas and things like what's your check size. What kind of industries do you focus on? What key milestones do you look for before investing? Again, I'll say that I feel down there at the bottom, again, kind of back to my common theme, which would be this is about a culture of building high growth businesses and understanding what the venture landscape really looks like. So to me, part of being prepared is simply spending time around other people that have done this before. If you're already starting your business, you don't have this opportunity, but if you're thinking about going into venture-backed businesses at some point, go to work for one, or find an opportunity to serve as an advisor with some skill set that you have for one, to learn the process and learn the cadence and the expectations around that. The really tactical stuff here around story and documentation and preparation is probably simply too much to go into today. But there are definitely lots of good online resources. Point to one being just kind of Y Combinator's Series A raise guide is a great one to turn to just for key points on the key things you want to prepare for in getting your company ready. On approaching VCs, so I mentioned earlier, I think the number one best source of figuring out where to find relationships and who to talk to is to talk to peers. And whether they're here in the region or outside of that, getting folks that have raised capital and reaching out to them and figuring out, what their learnings were along the way, and even potentially some relationships that they have is a great place to start. I think, as you're growing an early stage business, how many meetings to take? Well, starting to have those very early on to start to get the feel again, whether it's right for you, what investors you might go after given the opportunity to raise on down the road. We have founders that we've invested in that have literally taken hundreds of meetings prior to getting to the point where they raised a venture round of capital. It can also really suck people in once they get out there and they say, I know I can find that investor. So, I think that it's a balance of trickling that in over time, focusing primarily on your business so that when you are ready to raise, you have a good list to go after. Again, I can't emphasize enough, set up the meetings really early to feel folks out. And then and I'll go into more on process a little bit later to have, sort of a short list that you're going to target once you're ready to go out for your raise. Just a quick note on referrals and introductions. I think there is usually an investor founder split on the idea of cold introductions versus warm introductions. Warm introductions, just like any relationship, always help because it gives you a point of credibility. But I will say, I feel that in this region, there's a lot more openness to a cold introduction, and that you've got several investors here in the room that will generally talk to you as long as you're giving them a clear idea of what you're after. You make a personal connection or show them, hey, I am from the region. I really just want to understand the process better. Can I have 20 minutes of your time? I mean, I think that is the great thing about investing and founding in the Midwest is there is that openness. And so I do think keep it short and sweet and a specific ask on that. I'm just going to, again, probably entirely skip this one for today, just because there's so much to the actual pitching process, but this will be in the slides that'll be shareable. I find that I like this slide. I think this was a Y Combinator slide, but this just gives a little bit of perspective on very broadly what investors are looking for at different stages and kind of the things that they're trying to qualify for. So at the very early stage, folks like me, I'm just looking for any data point I can find, whether that is a personal data point, a business data point. I'm trying to put together they're trying to interpolate a line on very messy data points to kind of try to show directionally this looks like it's headed in the right direction. As you get, and so the key thing that can be a pitfall there is insufficient data. So as many good data points as you can gather, even before you have revenue, okay, I have customer signups, I have a product, I have a couple people on my team that are willing to go on this journey with me. Like any of those kinds of things early on can be positive data points if done correctly. I think also raising your first round of capital, it's always great to show anything more than nothing. So anything more that you can show that you've just accomplished is better than showing, oh, I'm just about to do this as soon as you write me that check. So always raising kind of just on the heels of doing something impressive. Then as you get forward in time, like we were talking horse and jockey earlier, it becomes more about the business. So a Series A round, which these days might be a $10 million round of capital, something like that. you can see there that there start to be more data points. They're starting to look for more of a true pattern of the data. So in this case, that's inconsistent data. Maybe you had one quarter where you sold $1 million of your software, and the next quarter you sold 100,000. And so the investor may just not see a good pattern that's showing a good directional, a good direction of where you're headed. And then Series B, it becomes even much more about that. So, they really want to see a very clear pattern. They want to see really clear KPIs of how the metrics are going to drive the economics of the business. But you may have some baggage that can come up and bite you. So in this case, it says poor or past data. So a little bit on process. This is running a fundraising process well. I mentioned quite a bit about preparation. I think the thing you're qualifying for is typically finding a lead investor early on. So there may be a lot of investors that say, I like your company and I like you. As soon as you find a lead investor or somebody gives you a term sheet, I'd love to invest in your business. And that can be a great signal. Those can be a great group of people to join in the deal. That's the model of a lot of venture capital groups or angel investors. But that can also be a false signal. So when you go out to raise and you're asking all these questions, you're really qualifying for who's going to lead the deal. And you're trying to go from introduction to term sheet. So that really is the process. Once you have a term sheet, it's not a done deal. They haven't yet invested in your company, but you've set terms and you've got a pretty good commitment and an outline of how you're going to do business together. So that's typically kind of the core process. For us, that's a 4-week process. That's what we set as our goal. It doesn't always happen that way. We've done it faster than that. We've done it a lot slower than that before. But if you're not in this world right now, it has sped up a lot in the last couple of years. And so we've really kind of tried to hold to a discipline of about a 4-week process. And that means we have to move fast. We need you to be organized so that we can move fast. And so again, just going back, and can't emphasize enough, get to know folks early on so that when you push go, they're ready to look at your company and really accelerate their process. I've given a few of these points already, but tracking is really important, especially if you end up having that 50 or 100 touch points with people. You go through your preparation process, just having a simple Excel doc that says, okay, investor, who's my main contact? What is their check size range? What are the key metrics they're looking for? And have I hit those? And then a great practice out there is to kind of rank them A, B, and C. Who would be your ideal investors? Who would be investors you'd be happy to have, but maybe aren't your first choice? And then the others. And you can be very strategic about that too, because maybe you float your company out to market early on. You're not sure. You're not sure if you're ready. You're not sure if your messaging is working. Well, I wouldn't go to your A list of investors initially. I would go out to the market to maybe the B investors to start to feel out, hey, is this resonating? Do I feel like I'm getting some interest here? And then open up to start getting back in touch with those folks that you really want to work with. A few things to do, again, about this being a highly founder-centric process at the early stages is very key to build credibility. Be truthful, be consistent. I have a caveat in there that says you don't have to share everything right up front. It's okay to be, structured and strategic about how you share information, because you can only fit so much into a 30-minute meeting, and you don't just need to air your dirty laundry out there. I think that's one thing about this part of the country. I'll say 99% of people I talk to, I think, are generally very truthful. Some are feeling that they need to be too truthful about their business, and they feel like, I really want to be sincere and honest about what I'm doing. Well, that doesn't mean you have to share everything. I think we can, as we get in, we can build this relationship hooked in a little bit. Then we need to learn the dirty details. But the overarching message is it is important to be transparent, share information quickly and succinctly, and be consistent with that information. I will say one of our key qualifying factors over our 4-ish week process is, do we feel the same about the deal? Are we as excited about it as when we started? Like, when we get to week 4, we've been talking about this thing for a long time. Are we still excited? Do we still feel good about the people that we're going to invest in? Or were there some things that cropped up that kind of really started to build a list of questions about it? So that's very important. I think simply being organized can really help with that credibility. Just, having your information ready and that sort of thing really can add to that. Being efficient, I think, again, that comes back to planning. You do want to have that list ready to go so that, in the ideal circumstances, you can flip the switch on when you're ready to go. You've hit your key milestone. You feel like you're right down the middle for your A list of investors, and you can get it done quickly. It tends to be a binary game in venture. When somebody wants to do the deal, everybody wants to do the deal. When anybody doesn't want to, otherwise nobody wants to do the deal. And so there's admittedly a herd mentality, a fear of missing out on a great deal out there. And candidly, to that bottom point, you can play that game. If you feel you have something going well, you can definitely learn to play the game. And raising money, just like negotiating for a car or anything else, it's a bit of a game. And so spending time with other people who have done it before can help you, again, really be ready for that process. I'd also say, it isn't just about the check size or the prominence of the investor. It's about who they are, what are the kind of people you're going to be working with, what kind of other intangibles do they offer to your company? Is say network really important for you? Is your industry network and connections? Well, maybe you need to go find an investor with that, and that's more important than a specific valuation. Is somebody going to spend real time with you? Do you want to build up a board that can really help you think through how to professionalize your business? That's another thing that I can tell you, there are people that will write you a big check at a crazy valuation and get you nowhere. And so finding that right fit, that's a good interpersonal fit, the kind of people you want to work with is really important as part of this as well. The term used on that last point is over-optimization sometimes, that it's easy to focus on trying to get the highest valuation because, hey, you've worked hard to build your company and you don't want to give up more of it than you need to. But there are a lot of traps to that if you're not being careful to qualify for who you really want and the right valuation. One thing about that is that, if you raise at a really good valuation now, typically you're going to be raising more money down the road, and you need to now justify that valuation. And if you want to keep up momentum, you've got to really hit excellent milestones to justify that next valuation. So if you've raised your seed really high level, you go out for your Series A and you can't justify that we're going to now double or triple valuation, it can be very hard to raise. Everybody says, whoa, what happened? Again, it's a herd mentality. So once people start to have hesitation, it often really starts to back off quickly. Not putting hair on your company, I think that's a challenge when whether you're from Kansas City or Wichita or any market where there's not lots and lots of transactions, lots of people that have done this before. You got to be careful who some of your advisors are. You might have had a great attorney for your business, your prior business, but now you're raising a venture business, and there's a whole different set of expectations around how you structure your company. Brian mentioned earlier LLC versus corporation. That's one, is that LLC has been used a lot for lots of different types of businesses, but venture investors are going to expect it to be a corporate. There are also things about just kind of general corporate and board structure and employee option pools and all this kind of thing that you want to kind of have vanilla for your company. You don't want to add a lot of unusual features to the business. You don't want somebody to invest 75% of your, or own 75% of your business from the outside when you're going out to raise seed. It's like, well, this person gave you some capital, but they took 75% of your business now and they control it. So that could be, that would be just not a venture deal at that point. Process can often take longer than you expect. So I mentioned again, our 4-week process, not just ours, but other, you can get out there and you learn things along the way, or something doesn't go right with the business in the middle of your fundraise. So you need to have some room in your timeline to both still be able to run your business and to raise capital. Take things personally, super important. I think of the companies, 21, 22 companies we've invested in, many of them, probably over the half of them, we looked at them earlier than we ended up investing in them. And so, and those folks that came back around and say, hey, listen, I need to raise $3 million. I thought I'd be raising 10 right now, but I've done some great things with my business, but I'm not ready to go out and raise 10. And we say, yeah, we really liked your business and we had a great relationship. We left it on very good terms. Like, that can be invaluable, and that can help. Having just a positive attitude and accepting feedback and building the relationship side of this, just like anything else, it's super important. Venture world is super interconnected, so keeping a positive vibe out there can go miles for you. Just a little thing, NDAs or deal agents, at early stage, it's just kind of an out-of-market thing. Like venture investors will not sign NDAs. There are a variety of reasons for that, but one is they're looking at tons of companies and they signed a bunch of NDAs. They probably could not track them. And there are a few other reasons for it. But if you have questions about that, ask people in the know. But I'm going to say, nobody's going to say ask for NDAs for a software deal. Following up. Another important thing is to, if you're building these relationships early on, be sure you are doing some follow-up, that you're doing timely follow-up. Newsletters are a great way to do it. I'll be honest, Maria's here, but in Techstars, during the program, they ask for a weekly update. And that's great for close mentors and things. But I think generally a quarterly update's great. And or after you've done something really hit a big milestone, send out an update to all the people you've been talking to. Hey, just landed our first big contract, just to let everybody know how well you're doing. It is never hurts. So I do like those. I love getting updates from founders. They're a little bit personal. That's great too. I'm going to this is my last slide. So I want to talk just a little bit, since this is about raising capital in this region, a little bit about what's different, because like I referred to Y Combinator, and Y Combinator's put a lot of companies through their program and been successful, but a lot of their advice is very useful, but some of it's also just not always relevant to raising capital in the middle. One reason is, I would say, depth of capital here. You don't have, the Silicon Valley's got more venture investors anywhere on earth. And so there's a whole range of options to go after. If you're based here, Brian's a part of great companies, we're a part of great companies, but they didn't probably have quite as many options to draw from. And so, like, if you have a really great founder that's been there before, high growth software enterprise model, there's a pretty good depth of investors both right here in the region and kind of in the broader region that may be interested. I know there are even companies here locally that are raised from really prominent investors outside the area. That can happen, but it's not the track for a lot of folks. And so depending on your industry and depending on the exact nature of what you're trying to do and how far along and how experienced you are, that is a difference. And so I think that understanding that just because the capital market is really hot right now does not necessarily apply to every business. And so it is a different game. It's more about building relationships with folks, also not just sticking to the angel investors in town, or the venture investors in the region. I would definitely look to build relationships more abroad as well, so that you are getting a good sense of what your different options are. Obviously, I'm partial to the idea of having some boots on the ground capital, because I think, number one, we really do care about businesses that are being built here, and we tend to spend real time with them. But I would also encourage any founder to go out there and search the landscape, see what works for you. Again, breadth of investment strategy and expertise. I think it's great that Groover's focusing on some hardware expertise and that sort of thing, because that'd be an area I'd say generally not super easy to raise capital around here in the region. Consumer oriented technology, just not an area that the region has a lot of expertise and relationships in. So, while I think you can definitely build a great business here, you're probably not going to have the depth of relationships and capital to be able to support your business. Investors like me don't really understand B2C businesses. I might try to help you find somebody that does understand that a little bit better. Also, just experience with venture-backed companies. I think there are lots of people that are, especially in this community, lots of people supporting the early stage startup community, which is an excellent thing. But a lot of those folks may have made their money in a totally different sector. They may not be attuned to the venture style of raising and what the expectations are, even if they've been successful in other sectors. So, the great angel investors know their limitations on where they should advise and where they should hold back and find somebody else to advise on some of those things. But just be wary and look for people that really get it in the region, so that you're setting yourself up with the best advice. I think a great thing about our region is I think founders are generally very high on substance. Our investment is, to Brian's point, a little bit more conservative, I'd say, than some places, although I think there are investors of different stripes everywhere. But our founders tend to be very problem-oriented. They're focused on a specific problem, maybe from an industry that they were in. And so there's a lot of substance there. They can build great, sustainable businesses off of that. But they're lower on hype. We like that. We like a little bit reduced amount of hype around a company, at the same time as that has a flip side of folks don't promote themselves enough. And so you need to hype yourself up. If you know you're one of those people that is a little more reserved in promoting yourself, maybe turn that up a little bit, because you're probably doing great things that people need to hear about. So I kind of touched on tough industries, process and terms. I would say we probably move a little bit slower, certainly less aggressive than the most aggressive investors around the country. But deals are getting done all the time around here as well. Terms are probably not going to be as inflated, but there have been some really amazing valuations and things in the region as well. So. But I would say, generally speaking, terms are not going to be quite as, quote, founder friendly. I think that founder friendly can have a flip side as well. So anyway, that's what I have for today. Really tried to cover a lot there, so I'm happy to answer your questions. Anyway, I'd love to talk after the fact as well, and let me know what your questions are.
Yeah, questions for Dan. Here we go.
So what are some of the different do's and don'ts that may differentiate between local boots on the ground VC entities, as you used the lingo previously, versus external VC entities outside our ecosystem here? And if you could specify some examples of how you would take that approach, or things you would clarify with them, how you would pursue that relationship, that'd be awesome.
Yeah. So, I think, one element of having local VC, I guess I would say this, if they're experienced, if they've done this a while before, I mean, they can be, a great advisor. They can bring other local resources. If you're hiring locally, if you are, looking for other resources locally, that's incredibly important to a business based here. They can also help you raise capital outside the area. And, one thing about having venture backing is simply that most venture investors have more relationships with other venture funds, and having one end tends to lead to more relationships. I think the likelihood of commitment is higher when you're local. There's a reputational component that doesn't necessarily exist as much with somebody that is coming in from outside the area. That said, we've had great relationships with funds out in the valley that we've co-invested with. We have them looking to us for kind of a feeder to some of their companies and that sort of thing. But I don't know if I'm getting exactly to your question, but I think the final thing I guess I'd say is a lot of what we're focused on is B2B enterprise software, where it's very much benefited by having local relationships, because a lot of the industries we're investing in are right here in the region. So the clients, the advisors, the potential acquirers are companies that you could find in a place like Kansas City or Dallas and that sort of thing. We have a lot of network there as well.
More questions for Dan. All right.
Hey, great presentation. One of the things that I struggled with the first time I raised money that I've kind of know about now, but it'd be great to hear from an investor's perspective, is you didn't, when you're seeking investors, you didn't hear yes or no. They drug you on indefinitely, and you're in the first funding round, you're maybe a little bit more desperate than other rounds, and so. Yep. How should founders manage that, and when to let go, or how do you manage it?
Yeah, that's a very good question. I think many times there's not a real incentive for the investor to say no. They like to keep the door open. I will say, as a fund, we work really hard at that. We try to, frankly, close the door firmly and then say, like, hey, let's talk 6 months down the road, so that they know that for this round, it's not going to happen. How to deal with that? I mean, I think is setting some timelines for yourself. I have dealt with this with some of our own portfolio companies where maybe they weren't quite hitting their marks, and they're having these conversations, putting some pressure on them and saying, listen, I'm ready to do this or not, or say, we're anticipating term sheets. If you have a little bit of a leg to stand on there, that can sometimes put the pressure on. But I don't honestly have a fantastic answer for you, because it's literally somebody on the other end being ambiguous with you, and that sucks. If others have suggestions on that have been on the other end of it, go ahead.
No, great presentation. So here's what I would say. Here's something not to do. You heard a lot of honesty and authenticity of how you would engage venture. We see it go wrong when you are trying to drive those timelines. And I have a term sheet coming from, or, well, Dan said he's in if you're in. Well, unfortunately, the community is incredibly well networked. So while you're kind of trying to grasp for building the FOMO, building a deadline, you got to stay away from anything that feels like not 100% truthful. Because oftentimes you'll get yourself in a bind, and now you're walking yourself. So I think you said don't put yourself in a corner in one of your slides. And it's, hey, we're closing by 8:30, other term sheets are in. And then, when it's October 10th and you're still talking, you've lost credibility, you've backed into a corner. So I think you just have to resist the urge. I would say ask lots of questions. What are your next steps? What are your timelines? Is this a decision that you can make? Do you have to take it to partners? Those show that you know the world a little bit, and in the kind of the leading questions, you can learn a bit.
So I'll go in a little bit on this, more on the founder side, because I've raised money several times and it was rough every time. One of the reasons the investors may hold off is they're playing schedule chicken. As long as if you're not going to close with somebody else, the longer you run, the more they know about how real you are. Like if you have any near-term milestones, they're going to wait to see you hit those before they put the money in. And so a lot of them are doing that dance, trying to get, the more real you are. We've already talked terms, but we know we'll get more confidence that putting the money in is safer. So they're they're playing a little bit of that side, and that sucks, but that's what they do.
Any one last question? All right, Ramsey.
The first one on the map, I think there might have been a problem. There wasn't an investment in Wichita. Is that true? Okay. All right. Okay.
It's Brian's fault.
Yeah. Okay. And then second to that, I guess, what would you look for in terms of investments that you're going after? Is there a minimum kind of revenue that you guys look at besides your kind of industry that you're focused on, or any other milestones?
But we are definitely look for companies that are, high scale enterprise software business. Typically, they are in 6-digit revenue. They're 300,000-400,000 in revenue. I'd say probably the typical company that we're investing in. We like that to be at a very high growth rate. We like that those data points are kind of showing early consistency and things. And so, at our stage, it's a balance. So sometimes we have a lot of good data points, but then something else about the company isn't quite right. In other cases, we have only a few data points, but we love what they're going after. I would say just like maybe one piece of advice on, not just, kind of whatever early traction you have, but really how does that translate to a clear growth plan? What did you learn when you sold those first couple of customers, and how are you translating that into your growth plan going forward? How will you build a sales team around it? That sort of thing. When we can kind of hear that clarity of story and consistency, that's really important for us.
Sorry. So your company doesn't on that note, doesn't really deal with startups very often.
If you want to call a pre-revenue company the endpoint of a startup, then no, we rarely do that. So I think early stage, seed stage venture company investments is what we make. Thank you.
Yeah, I don't want to. Sorry, I had to give it up for Dan. Right? Yeah, thank you. Dan will be around for a couple minutes. There's all kinds of stuff to pick his brain on, but we're going to get going on our 3 o'clock here in just a couple minutes. So 3 o'clock, stick around for our next one. Thank you.